Welcome to a journey that could change the way you think about money and investing forever. Did you know that if you had invested just $100 in the S&P 500 50 years ago, you'd have over $12,000 today? That's the power of long-term investing, a method that doesn't just aim to increase your wealth but to multiply it exponentially over time. In this video series, we'll explore the often overlooked strategies that can help you build a substantial financial portfolio and ensure a prosperous future. We'll debunk common myths that may have deterred you from investing, reveal why playing the long game in the stock market could be your best bet for achieving financial freedom, and show you how to harness the principles used by some of the world's most successful investors. From the magic of compounding interest in Chapter 1 to the critical importance of legacy planning in Chapter 6, each segment of this series is designed to provide you with actionable insights and real-world advice. Whether you're a seasoned investor or just starting out, these chapters will equip you with the tools you need to make informed decisions that align with your long-term financial goals. Stay tuned as we unlock the secrets to turning today's investments into tomorrow's treasures. Let's get started on the path to riches. Chapter 1. Fortune's Patience, the Compound Interest Effect. Imagine you could turn a small pile of cash into a mountain of money over time. That's the magic of compound interest, often hailed as the eighth wonder of the world by investment enthusiasts. Albert Einstein reportedly dubbed it the most powerful force in the universe, and it's easy to see why when you look at long-term investing. The concept is simple: reinvest your earnings, and then earn more on your earnings. Over time, even a modest investment can grow exponentially. Consider this: if you invest $10,000 at an annual return of 8%, in 10 years, you won't have just an extra few thousand, but over $21,500. And in 30 years? That figure balloons to nearly $100,000, without any additional contributions. This isn't just theoretical. Historical data shows that the S&P 500, a common benchmark for US stocks, has returned about 10% per year on average since its inception. By regularly investing in a diversified portfolio mirroring such indices, individuals can harness this growth, often without the need to actively trade or frequently adjust their holdings. It's not about timing the market, but time in the market that counts. Legendary investor Warren Buffett once said, "Our favorite holding period is forever." By avoiding the urge to jump in and out of the market, investors minimize the risk of missing out on periods of significant gains, which often come unexpectedly. Compounding works best when given time, so the earlier one starts, the better. For example, someone who begins investing $300 a month at age 25 will accumulate significantly more by retirement than someone who starts at 35, thanks to the additional compounding years. This is why young investors are encouraged to start early. Even small amounts can grow into substantial sums. Chapter 2. Market Myths Debunked. Ignore the noise. When it comes to investing, the market is full of noise: daily price movements, trending stocks, and economic news that can tempt even the savviest investors to stray from their long-term strategies. However, the truth is, reacting to market fluctuations can often do more harm than good. Frequent trading in response to market noise can lead to higher transaction costs and taxes, which eat into your returns. A study from the University of California found that individual investors who traded the most frequently earned an annual return of 11.4%, while the market returned 17.9% over the same period. This gap underscores the cost of overactivity. Instead of focusing on short-term fluctuations, long-term investors thrive by setting a course and sticking to it, come what may. This doesn't mean ignoring your investments, but it does mean you should resist the urge to act on every piece of news. As investment guru Benjamin Graham noted, the investor's chief problem, and even his worst enemy, is likely to be himself. By adopting a long-term perspective, you can view market downturns as opportunities rather than threats. Historically, markets have always recovered and reached new highs. Those who maintain their investment course during downturns are often rewarded with superior long-term returns. Remember, the stock market is designed to transfer money from the active to the patient. By staying committed to a long-term investment strategy, focusing on quality investments, and utilizing tools like dollar-cost averaging, investors can avoid common pitfalls and build significant wealth over time. Chapter 3. Wealth's Quiet Builders, the Power of Dividends. When we talk about building wealth, dividends often don't get the spotlight they deserve. Yet, they're fundamental in the realm of long-term investing. Dividends are your share of a company's profits, paid out usually on a quarterly basis. They may seem small on a per-share basis, but over time, their impact is monumental. Did you know that dividends have contributed to approximately 40% of the S&P 500's total returns since 1930? This isn't just pocket change, it's a significant boost to an investor's portfolio. Reinvesting these dividends turns the already powerful force of compounding into a wealth-creating machine. Instead of taking those dividend checks as cash, if you reinvest them, you buy more shares of the stock, which then means more dividends in the future, creating a cycle of increasing returns. Consider the case of a company like Coca-Cola, which has not only paid but also increased its dividend for over 50 consecutive years. An investor who held onto these shares over decades would have seen returns multiply many times over, just from dividends alone, even before factoring in the stock's price appreciation. John Bogle, the founder of Vanguard, often emphasized the importance of dividends in investing. He advised, "Do not underestimate the power of reinvestment of dividends. It is the sleeper that can turn a modest stock holding into a serious nest egg." It's clear that including dividend-paying stocks in your portfolio isn't just a throwback strategy. It's a forward-thinking approach for steady growth. The strategy here is simple but powerful. Look for companies with a strong history of paying dividends. More importantly, ensure they have the potential to continue doing so. A company's track record of dividend increases and its payout ratio, the percentage of earnings paid out as dividends, are good indicators of its dividend health. Chapter 4. Hidden Gems. The value of underappreciated stocks. Value investing is all about finding diamonds in the rough, stocks that the market has undervalued. These hidden gems often go unnoticed in the hustle and bustle of flashy tech stocks and headline-dominating giants, yet they offer potentially higher returns for those patient enough to wait for the market to recognize their true worth. The father of value investing, Benjamin Graham, taught that the secret to successful investing lies in the margin of safety, buying stocks for less than what they are fundamentally worth. This principle protects investors from significant losses during downturns and provides substantial upside as corrections take place. Here's a compelling fact. During the tech bubble of the late 1990s, while many chased high-flying stocks, value investors who focused on underappreciated sectors like energy and financials saw substantial gains in the early 2000s when the bubble burst and the market's favor shifted. This illustrates the cyclical nature of markets and the opportunity in sectors that aren't in the limelight. Finding these stocks requires diligent research and analysis. Look beyond the popular metrics like price-to-earnings (P/E) ratio. Consider other financial health indicators such as price-to-book (P/B) ratio, debt-to-equity ratio, and free cash flow. These can provide deeper insights into a company's real value that isn't reflected in the current stock price. Investing in underappreciated stocks isn't about catching falling knives or betting on turnaround miracles. It's about discovering companies with solid fundamentals that are trading below their intrinsic value due to temporary issues or general market misperception. Remember, as Warren Buffett, a disciple of Graham's teachings, often says, "Price is what you pay, value is what you get." By applying this wisdom, you can unearth stocks that offer both safety and an opportunity for significant growth. Chapter 5. Emotional Fortitude. Staying the course when others falter. Investing isn't just about numbers and charts, it's also a test of your emotional strength. Market downturns can be scary, leading many to sell their investments in a panic. However, the key to long-term success lies in staying calm and sticking to your strategy, especially when others are fearful. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This advice underscores the importance of emotional discipline in investing. During market dips, while others see disaster, long-term investors see opportunity. This isn't about being opportunistic in a negative way. It's about understanding that good companies can become great buys when market sentiment is down. Statistically, markets rise more often than they fall. The S&P 500, for example, has ended up positive in 30 out of the last 40 years. This suggests that maintaining a long-term perspective and resisting the urge to react to short-term fluctuations can lead to profitable outcomes. Here's a strategy. Set up a systematic investment plan that automatically invests money at regular intervals, regardless of the market's ups and downs. This approach, known as dollar-cost averaging, helps reduce the emotional stress of deciding when to buy, and over time, it can lower the average cost per share of your investments. Emotional fortitude also involves regular portfolio reviews, perhaps quarterly or biannually, to adjust to any significant changes in your financial goals or market conditions, but not so frequently that you're tempted to overreact to minor market movements. Chapter 6. Legacy Planning. Building Wealth for Generations. Long-term investing isn't just about building wealth for yourself. It's also about setting up future generations for financial success. Legacy planning involves more than just saving money. It includes creating a comprehensive strategy that ensures your wealth is preserved, managed, and distributed according to your wishes after you're gone. One important component of legacy planning is the effective use of wills and trusts. A will can direct where and to whom your assets should go, while a trust can provide additional control over how your assets are used by future generations. For instance, trusts can be structured to release funds to beneficiaries at certain ages or milestones, thus helping manage wealth responsibly. Another aspect of legacy planning is tax efficiency. For example, in the United States, assets like stocks held for over a year are subject to long-term capital gains tax, which is generally lower than short-term gains tax. Proper planning can help minimize the tax burden on your beneficiaries, maximizing the amount they receive. Educating your heirs about the principles of value investing is also crucial. Teaching them how to invest wisely, understand the importance of patience in investing, and respect the value of money can help sustain your legacy of wealth far into the future. Long-term investing is not just about creating wealth, it's about creating a tradition of financial intelligence and security that benefits your loved ones long after you're gone.